A salary sacrifice arrangement is often used in connection with pension arrangements because it can result in higher take-home pay due to savings in national insurance without any loss in pension contributions. Salary sacrifice is commonly referred to as salary exchange because it involves the employee receiving an equivalent employer pension contribution in exchange for a reduction in their gross salary. The best way to explain how it works is through looking at an example. This is Mira, and she earns £35,000 of gross salary each year. So after she's paid income tax and national insurance, she's left with £27,079. These figures are based on the current tax year ending March 2018 and assume she has the standard personal allowance. Mira pays 3% of her gross salary of £35,000 into her workplace pension, which is a group personal pension scheme, meaning that employee contributions are deducted from take-home pay, net of basic rate tax and national insurance. This means that she actually pays £840, and the other £210 is in the form of tax relief. She also pays £126 in national insurance, which we'll look at in a minute. Her take-home pay is £26,239. Her company pays 7% of her gross salary of £35,000 into her pension, so she benefits from £3,500 of pension contributions each year, including her 3% contribution. Now we can see what would happen if Mira had a salary sacrifice arrangement. Her employer pays her 3% pension contribution of £1,050 as an additional contribution, so her total pension contribution remains the same at £3,500. This means that Mira doesn't make any pension contributions, and her gross pay of £35,000 can be reduced by £1,050 to £33,950. She'll pay £210 less income tax, but the key point is that Mira's national insurance liability is reduced by £126, which results in her take-home pay increasing to £26,365. And her pension contributions remain the same. Mira's employer will also save £144.90 of national insurance because the amount sacrificed is £1,050 and the current employer national insurance rate is 13.8%. Some employers pass back some or all of their saving to the employee as an additional employer pension contribution. Switching to a salary sacrifice arrangement could potentially lead to Mira taking home more money without any effect on her pension contributions, and her employer makes a saving too. But it is important that any changes to salary-related benefits are considered and that the arrangement is documented correctly. For example, employee benefits like life insurance are often based on a multiple of gross salary. So most companies keep records of pre-salary sacrifice earnings for this purpose. Applications for mortgages can also be affected too, so it is important that consideration is given to any potential reduction in gross salary. Higher rate taxpayers switching to salary exchange who have been paying into group personal pension schemes and claiming back higher rate relief via HMRC should make sure they inform HMRC as soon as they change to salary exchange, as tax relief at the highest rate is effectively achieved at source via salary exchange. If you are a higher rate taxpayer who has not been claiming this additional relief, you may be due a tax refund. Beckett Financial Services is an award-winning firm of employee benefit consultants and chartered financial planners. We have been helping corporate clients for nearly 30 years. To talk with a consultant, phone 01284 754 500 or email info@beckettinvest.com. Our website is www.beckettinvest.com, and you'll find our social media links there if you would prefer to connect with us in that way.